Based on time frame, we have divided the options into three categories. Neeraj has already explained you, but still we'll just have a look at it. So one is a weekly contract, then you have the monthly contract, and then you have a 3 monthly contract, which is also known as a quarterly contract. So weekly contracts are for a week. So generally they have very high liquidity. Most of the price action and volume, everything happens in weekly contracts. Uh, Comparatively, monthly contracts have less liquidity, and if you look at the 3 monthly contract or quarterly contract, they have very low liquidity. Priced in terms of weekly contracts, they're very less priced compared to a monthly and quarterly contract. In terms of volatility, the price movement, if you see, the volatility is very high in the weekly ones, whereas the monthly, it's relatively slower, and in the 3 months or quarterly, it's very less. Generally, people who play on weekly contracts, they look at the contracts expiring within a week. So their volatility is relatively smaller compared to the other two. So there you play on a volatility of around 2% to 3%. That's the weekly volatility. For monthly, you play around 5 to 6% in terms of Nifty, and for quarterly, it's around 10 to 15%. That's the range which people play. Useful for very fast and momentum trades. So like if you're playing on weekly contracts, you buy today, exit today itself, or maybe you exit in 1 or 2 days, of course, before the expiry. Whereas monthly contracts for the index, generally they're used for hedging purpose, and quarterly also are mostly used for hedging purpose. Of course, for stocks, it's used for speculation. In terms of when you're looking at weekly contracts today are available for the index options, whereas monthly contracts are available for index as well as the stock options. So for people who play on options using stocks, so for them, they generally prefer going in for monthly contracts. And quarterly contracts, as we shared, it's mostly used for hedging purpose.